Hey everyone, we're here with the Holy Macro Show, and obviously there's a lot going on in the market this week. I always say I'm going to stop saying that at some point, but when there's so much going on in the market, we should probably talk about all the things that are going on in the market. Kashop is here with me today, and he's been talking about a lot of things in the markets for a while. Which is one of them is Bitcoin. We've been talking about that. Kashop sold his Bitcoin pretty early. So first off, Kashop, how are you doing today? I'll bring up the slides. We'll talk about those in a second. So how are you doing today? What are you seeing in the markets? And what's the biggest thing that's standing out to you right
Hey Jason, and hi everybody. I'm doing great because it kind of feels like whatever I've been positioning for is finally working, and it's a really good feeling, especially when you've been just sitting there waiting for things to happen, and then they start to happen, and it's a good adrenaline jolt, not anything more than that, nothing emotional. It's a good adrenaline jolt that I feel. So when I look at market, I mean, we all knew. So here's the thing. Everyone knew AI was a bubble as far back as, maybe a year ago or maybe 9 months ago. And the justification was always, well, the Fed is cutting rates and Trump is bullish for America. And look at all the deals he's making. Look at all the investments he's bringing back. And then, look at data center activity. Look at how much is being built in the US. You have cheap natural gas and you're building all these things, and US is the world leader in technology and all those reasons. So nothing mattered except for the fact that companies were spending money on AI. It's like before 2008, you had this thing where housing prices were going up, so people were refinancing and using that money to buy flat screen TVs and go on yacht cruises. So
now?
that was what everyone talked about. And this year, it's been nothing but look at all this data center spending, look at all the stuff that they are building, and this can go on forever. Even though it doesn't make economic sense, all that stuff doesn't matter, it can go on forever. This was the thinking. And then September came and people kind of thought, hey, September, this is a scary month because they remember September 2008, they remember September 1929, and drew all those parallels, and we were like, we are getting into scary territory. Then September came, up month, and everyone cheered. Then October came, and everyone was like, oh, October, that's another scary month, even though seasonally that's the strong or start of the strongest period for the S&P 500. So October to March is typically the seasonally pretty strong period, and Jason has the stats on this. But everyone thought, okay, October, we are going to get a crash, we're going to get a crash. And it sort of looked that way, and then nothing happened. Coming into November, everyone thought, okay, we are going to melt up into year end. And boom, here we are, 14 days into this month, and it's getting scary again. Now, the fundamentals turned bearish a long time ago. The technicals turned bearish just a little while ago. And this week, actually, Monday should have been a continuation of the Friday's move lower. And it wasn't because Trump tweeted out something saying $2,000 stimulus checks to every American, and then markets went straight up. And then when the market realized, the algos realized that wasn't true, that was fake news, then they started going straight down. And that brings us to today. So here's the thing, like I have been pretty cautious for a long time. I wouldn't say bearish because that's a stupid thing to say when your entire portfolio is filled with stocks. So if you're bearish, then you're sitting on 100% cash, or you're sitting on 30-40% cash at least, and I'm not. So I wouldn't say I'm bearish. I mean cautious. And I outlined this deleveraging playbook. I put a part of it on Substack. The date on that is October 12th. And October 12th to November 14th, I've been just sitting here waiting, waiting, waiting. There has been deleveraging in some parts of the market, but not overall. And today, I think we are finally starting to see signs of the overall deleveraging. Now, will this
Will this
continue?
continue?
I think so. And here's the thing, it's not just that I think so. If you study economics, any school of thought, every school of thought will tell you that these kind of events, recessionary events, are good for the economy because Shamsta calls it creative destruction. The Australians call it liquidation of malinvestment. So, what this does is it clears off all the poor decisions, the impacts of the poor decisions made in the past, so that the economy can heal and start off on a stronger footing. So, think of it this way, it's like a most outrageous example. people suddenly woke up and realized that tractors are better off in New York City than in Columbus, Ohio. That's where Jason lives. So, they decide that, instead of cornfields, let's have them in Manhattan. And then they bid up tractors, they put them all over Manhattan. And then all of a sudden, people come to their senses and say, what do we do with tractors in New York City? We don't need them here. Let's move them back to the fields. Now, is the economy better off when the tractors are in the fields or when they are sitting in New York City? Well, they're definitely better off in the fields. So that's what the liquidation of malinvestments does. When people make poor decisions, they face the consequences of it. The capital gets reallocated to wherever it produces value best, and the economy goes off in a stronger footing. Now, let's say the government intervenes and says, no, we need to keep these tractors in Manhattan. What happens to the cornfields? Well, the cornfields wither. What happens to New York real estate? Now it gets even more crowded. So, is this good for anyone? Not really. And that's why government shouldn't interfere with the free markets. That's the Austrian approach. That's pretty much the Chicago approach as well. So, what we are seeing now is all this AI malinvestment, people bidding up these companies just because they are spending tons and tons of money. OpenAI is now saying $1 trillion worth of AI investment, which is crazy. Now, when these companies are saying stuff like this, the market is saying, no, I'm not going to allocate capital to all this. I'm going to allocate capital to oil wells, gold mines, copper mines, corn, soybeans, pretty much all the stuff that the world actually needs. So you're seeing this rotation taking place. You're seeing this rotation out of tech, crypto, AI into all the other sectors that have kind of been neglected for a while. So this deleveraging is great, it is healthy, and it is exactly what the economy needs.
Yeah, I think it's, so many people, and sorry, my mic was on the wrong mic earlier, if anybody was listening. But, so many people are looking at the market in so many ways at the moment, which is everybody thinks it's everybody's fighting the last war. It's, my buddy Weitzel wrote a really great paper called Pavlov's New Dog. And the idea of like all of these changes that are happening in the market currently, and at the same time nobody can adapt to these changes because they've been trained in such a way to buy United States stocks, continue to buy bonds. Big tech will never lose. Like you continue to think like what has happened will continue to happen forever, and the markets change and they adapt over time. And I think we're really seeing that right now. And it's like you made the and this is what I love about what you do, which is like you're not afraid to make a big call and say, hey, like, Bitcoin, for example, hey, I'm going to be out of this for a while. Yeah, it could go up a little bit more, but for me, I'm seeing reasons to not be in this. And that's the same thing like any trader should do. There should be a point where you're out of just about everything. For me, it's like, there's a point where I'm out of every single asset, and I know that exact number every single day. And for a fundamental guy, it might be there's a point where I see something that I've been looking for that I know I need to be out of these assets at that moment. And so, making these big calls of going like, hey, I'm done with Bitcoin. Hey, I'm rotating out of, I don't think technology has much further to go. It's once again, we're probabilities. Like we're all playing on probabilities, whatever style of trading we're doing. We don't know anything certain. We don't know the exact timing of things, but we can understand like markets are rotating under the surface, and we've been seeing that all year long. And you've been wanting to be in these areas. Like Kashap and I have been very, very long on the gold miners. We've talked about this every single week. There hasn't been really a time where we've even talked about selling the positions. We keep talking about the different environments that gold could really do well in here. Maybe some of the speculative names would go down if we get into like a bear market style environment. But if you're talking about gold and maybe some of the large cap names, I think they're probably fine in just about every environment. I'll let Kashap speak for himself on that, if you have something to add on that one. But looking at the idea here, to me, the biggest idea that we've been talking about, that we've been just pounding the table on, is the fact that the Mag 7 is probably not going to be the place you want to be over the long term here. And so many people thought that was like ridiculous and you don't want to do it. However, it's like the numbers were telling you this all year long, which is, gold miners hitting over 100%. Metals and mining putting in a great return over 50%. Yes, technology caught up a little bit, but that was mainly driven by semiconductors. So, if you continue to look at the moves that have been happening under the surface, international stocks, that's another one. And if we're talking about gold miners, copper miners, metals and mining, we also have to bring up lithium. We also have to bring up palladium and platinum. We also have to bring up the fact that not bonds, but grains are starting to bottom out. So like we see a lot of these reasons to continue to be bullish on those areas, and a lot of reasons to start thinking like, hey, like the Mag 7's such a big thing and so concentrated in the market. If this thing turns down, the market can't be in good shape. And that's something that like you and I have talked about a bunch, and I'll pass this to you in a second because I want to hear your thoughts on this as well. But if we're looking at the Mag 7 and we see this huge weighting in things like, the Nvidias, the Apples, and so on, these $5 trillion companies, can the market sustain itself anymore without these things? Like if we got in a scenario where like a lot of people keep saying like, maybe they stop, but the bull market will keep going. Yes, maybe stocks in certain sectors will continue up, but the S&P 500 as a whole is so concentrated in technology and in big technology that I don't think this thing can sustain itself anymore without those big tech names, unless those big tech names go from $5 trillion to a lot smaller, or ExxonMobil and some of these gold miners end up in the S&P 500, and those become the new Mag 7, so to speak.
So if you look at S&P 500 by market cap, it's around 2.5 times the all the deposits in the banking system. So it's that big. Now you have a correction in the S&P 500. Let's just say Nvidia corrects to just 4 trillion or 3.5 trillion. Apple corrects from 4 to 3, and same with Microsoft. So you have these big corrections. How much money can the Fed print to really offset these corrections? Well, they really can't print, because you print a trillion, fine. Nvidia loses that in a week, let's say. Now, how do you offset that? And the problem with the Fed printing while stocks are deflating is that the Fed printing isn't going to stop stocks from deflating, because there are two components here. The first is when the Fed prints money, markets go up, bank deposits go up, money market funds, balances in money market funds go up, everything goes up, inflation goes up. But when the Fed prints while stocks are deflating, it is not necessarily true that the newly printed money will go back into equities. It could go into something completely different. It could go into commodities. It could just cause inflation even as stocks go lower. And we have seen this happen before. So in the 1970s, I think it was 1979, Business Week came out with a cover saying the death of equities. And they said that even though the Fed was printing. Why? Because the money was going into commodities. So pension funds were requesting permission to violate their stock and bond mandate and go into alternative investments. So let's say the Fed starts printing when stocks crash. Does that mean the S&P will inflate again? No, not really. And this is kind of one of the big myths that everyone believes right now, which is that, yeah, the Fed said they're going to rescue QE in December, so buy the dip. But okay, you buy the dip and the Fed does resume QE. And what if people don't buy into Bitcoin again? What if people don't buy into AI again? Then what? And this is the scenario no one's talking about, no one's prepared for, because I mean, we have had a bull market in technology for such a long time, people take it for granted. So you really need to read your history, go back to the historic parallels to kind of understand this. So you go back to 1989. So Japan was the number two economy in the world. There were so many books written about Japan. People thought it's going to overtake the United States. The Japanese way of doing business was being studied. People were learning Japanese. And then they had this big move up to 1990, and then a bust. And in that bust, the Bank of Japan kept printing money. In fact, they kept printing money for next 2 decades, and they still couldn't get the Nikkei back to its previous high. And then Abenomics comes along and he says, let the Bank of Japan directly buy the equity market. So it's
Yeah.
like if the Federal Reserve is buying the SPY ETF every day, which is what the Bank of Japan was doing to the Nikkei, the Japanese index, and they still couldn't get it all the way up to the highs. And now finally Nikkei is at 50,000, which is like a 25% gain from where it closed in 1990. And it took 2.5 decades of money printing to get it there. And it's the same way. You go back to the NASDAQ composite, which was the big index back in the dot-com bubble. It took 14 years for the NASDAQ composite to break even. And during these 14 years, Alan Greenspan printed money, Ben Bernanke printed money, and then Yellen printed money, and still it wasn't enough. So it took that much money printing to get it back to its nominal highs. You look at Cisco, it's still nowhere close to where it was at the top of that cycle. So money printing alone is not going to be enough. There's got to be some other catalyst. Now, sure, uh, you print money over 2 decades. I'm pretty sure Apple and Nvidia and everything will go up just because the denominator is so debased. But then, if you're printing money at that rapid a pace, then you really have to compare stocks as a ratio to something else other than the US dollar, which is gold. Now, when you look at the S&P 500 priced in gold, it's actually gone nowhere in something like 25 years, I think. So since 2000 to now, S&P 500 priced in gold has gone nowhere. Same with Bitcoin. You look at Bitcoin priced in gold, it's below its 2021 highs. So it hasn't kept up. So in nominal terms, sure, money printing will sort of make things go up in the long run, but that's not the bet you want to make. The bet you want to make is when the Fed prints money next time, where is that new money going to go into? It's not going to go into your previous year's winners. It's not going to go into last year's trades. So you have to figure out where it's going to go into next. And that's what we as macro traders do. So both Jason and I, that's what we sit and figure out. And he has his systems and I have my systems, my way of doing things. So that's what we do.
Yeah, I think it's really important to just understand that fact, which is where's money going to go next? Like that's it's the biggest thing I think we do as macro traders. I think it's easy to go, hey, you know, like looking at price signals, for example, or looking at fundamentals, for example. That all, you know, it can work, but what really is the catalyst to make you really make a lot of money, or what you actually look at next to take these signals in? Well, that's the macro, and that's figuring out where money's flowing to next. It's the reason why, you know, I always bring up that chart on gold, copper, oil. It doesn't tell me timing. The timing of it, I have no idea because the market doesn't move on my time. I would love for energy to just take off and rip everybody's faces off today. However, I am not in control of what the market wants to do, and the market doesn't care what I want. So I think it's just a continuation of here. We just need to continue to understand what's happening, like what's really happening right now. Being present in the market, what do you see happening? And I think the answer to me is money's flowing out of anything that isn't real at the moment. Like if we're like some very speculative tech names, sure, we see some of those moving and they look decent. But if we're looking at, you know, these huge companies, we're seeing like these valuations do matter. You know, at some point they're going to come back to reality at some point. Nvidia will come back to reality at some point. That doesn't mean I'm saying like Nvidia is a bad company. It doesn't mean I'm saying Apple's a bad company or a bad investment over the next 30 years. I'm saying as a trader, like things ebb and flow. And you want to be in the strongest names to make the most amount of money most of the time. And what's moving strongly? Where's money flowing to? Well, it continues to flow in these different areas. Whether we're talking about gold miners, lithium names, steel stocks, aluminum stocks, like copper miners, like we're seeing them move into these different areas, and especially international wise. And I feel like people miss that point and are missing out on a lot of gains here. So Freely brought up that he likes this chart. And looking at this chart, yes, I'm a big fan of this one too. Kashat brought it today. We used to have updates on this once in a while, and I would remake it, or Grant actually was really good at remaking these and updating them. But I do think that it's a good time to bring this chart out once again. I think this is Prescott. Yeah, it's Prescott Capital. And looking at the third wave of inflation, like it's something that people have been talking about. Now, one thing to say, and Kashab, you could speak to this as well, is when we look at these charts and we look at the way inflation was weighted back then, I put money that this chart would look almost identical today if it was still the same weighting of inflation that it was back in the 70s. And I bet that spike would have happened, let's say 2023, we just saw another spike up, and then a consolidation for the next year or so, let's say 24 to almost today, a little bit higher today maybe, and then another big wave up. So I do think that like we're really close to this third wave of inflation. And I think that's really the point where you start to see oil really get to those crazy levels of $150 and so on. I think that's when you see the rest of these areas really take off in a way that people haven't seen in many years. And so, Kashap, what are you seeing when you look at this chart?
So, to your point on oil, I think so. I think that's really the missing piece here. So, and yes, I completely agree with you. If you go by the shadow stats methodology, they do the CPI calculation as if it were the same composition as it was in the 1980s, and they project much higher inflation right now than what the current CPI is. And I mean, the CPI has kind of become a joke. So, April 2024, coffee prices shot up, so they decided let's remove coffee from the CPI.
Yep.
And health insurance premiums go up, but they say it's going down. And the reason for that is they don't calculate health insurance premiums. They ask insurance companies what is their profitability. And when they say, well, my profitability has gone down, then they say, okay, well, that means health insurance premiums have gone down. It's a completely ridiculous way of doing things. And it's even worse right now because of the government shutdown. I think it was JP Morgan or some of these big firms which did a study and said there are so many empty cells in the CPI Excel spreadsheet that they don't even bother to calculate those numbers. They just put in random values and they just give us the data. And that was an eye opener for a big chunk of the community, which relies on this number as if it were, some unadulterated truth, and it's not. So, looking at this chart, all I can see is it's going to get much, much worse. Inflation is going to get so much worse. And this is without even taking into account the tariffs, without taking into account all the unemployment, not the unemployment, sorry, the emigration out of the US. Like people are not working because you don't want to get deported. So what does that do to the labor supply? The labor pool shrinks. And what does that mean? It means higher cost for the producers, which means higher inflation somewhere down the road. Now, to offset this, you have the deflationary forces, which is you have bankruptcies rising, and you do have these other factors. For instance, oil is kind of stuck at 60. I don't know why, but it's kind of stuck at 60, and that's probably the only reason inflation is at this level. So I think when we see energy moving, it's going to escalate really, really rapidly. It's going to be so rapid that we will not be prepared for it. And energy moving, so the title of this episode is Has the Bear Market Already Started? Now, the only thing which would prevent me from saying definitely yes is the fact that energy hasn't moved. So if you look at all the past recessions, it was followed by energy having a big up move, and energy kind of got to a point where it killed the economy. Meaning energy prices got so high that the inflation got so much worse that the economy just stuttered, and then you had the recession. So higher energy prices precede every single recession in history, and we haven't seen that today. So that's the only factor which tells me I'm not very sure if we are already in one, but everything else points in that direction. And this recession, I think we're probably going to reach a point where energy goes up during a recession, which is what we call stagflation. So I think that's what we are setting up for. I'm not going to make predictions as to, yes, this is definitely what's happening, but it kind of looks like that's where we are heading.
No, I agree. And so Nick also mentioned the volume for Kashap. I turned it back. I turned his volume all the way up. I have settings over here too, Kashap. So I turned your volume all the way up. So Nick, let us know if that sounds any better next time Kashap is speaking.
Yeah, I moved it a little closer. Just let me know, because I know I
That
had
sounds
this
a lot
issue in
better.
the last. Yeah. Okay.
Yeah,
Okay.
it sounds really good to me, but you guys let me know, because I know
Okay.
there's a difference between both of our mics, I'm assuming. But
Right.
but yeah, so looking at this, I agree, which is the simple fact of, if you look at 2008, for example, Okay, Nick said it's a lot better. So if you look at 2008, for example, people forget like the energy move that happened. Like everybody forgets about this. Like I don't know how, but every single person is like, oh yeah, well, energy in 2000s, like, and every time I bring it up, people are like, oh, I never really looked at the energy market in the 2000s. It's like it was a huge move. I think the XLE as a sector was up 300%. Some of the stocks hitting 1,000, 2,000 in the large cap names. So it was a really big move in the energy stocks that year, or that decade, basically. And then you get to this big blow off top that happens. And when does that happen? Basically from 07 into 08, right into the recession. So think about, and one that's in recent history to pay attention to, which is off of the 2020 lows. You get basically 2020 happens. You have oil prices go negative, and then oil prices just continue to move up higher at a very fast rate, as well as the XLE sector started to move higher at a very fast rate starting in November 2020. So then November 2020 happens. We get this massive skyrocket in energy stocks and then oil stocks. And then what happens in 22? Well, the stock market can't catch a bid, but energy stocks are still moving up. I think energy still closed the year around 50% in 2022, and the S&P 500 would have been down 20. So that's usually what you see around like these recessionary cycles. So like I could see a scenario here, and this is what I've been thinking the whole time, which is like, I don't know exactly when technology will completely die. Is it today? Has it already happened? I'm not 100% yet. The trend is still not great, but it's not bearish yet, long-term primary trend. And when that happens, I'll come back on here and say, hey, that the primary trend is broken. But at the moment, I'm not seeing it yet. But what I am waiting to see, and just like Kashap is talking about, like I really think energy prices, if we're in an inflationary cycle and all these other sectors are moving, that's the biggest catalyst to the end of the bull market for a lot of things. And so keep that on your radar. And it's not something that's going to happen quickly. It's something like 21 was a period of time. Kind of reminds me of today, just different sectors moving. 21 was a period of time where you had the S&P 500. It's kind of struggling. It's in an uptrend, but it's struggling. It's really underperforming energy. It's really underperforming China. It's really underperforming small caps, micro caps, and so on. And so like today, it's kind of, the S&P 500 is in an uptrend, but it's really underperforming gold miners, copper miners, steel stocks, and some of these other commodity-based areas that are doing really well. So, it reminds me of today in that sense, but the only thing that's missing from that story is energy. So I think that's a good catalyst for everybody to keep an eye on. Going to the next one, go back one. So all these headlines came out, and I wanted to pass this off you, Kashap. You talked about this a little bit earlier, where we had, some of these are like just Trump throwing stuff out there. He has a tendency to throw things out there, and sometimes they really do happen. Sometimes he has a tendency of throwing stuff out there and nothing happens, and he's just trying to pump the market or do whatever he's doing. So when you're seeing these headlines, as a macro trader, how do you look at these? And then after that, we'll get to Paris's question, and then there was another one up here too from Eric.
So the headlines, it's if you're a day trader, let's say, even if the headline is bullshit, it's never going to happen, it's never going to pass Congress, and it's just throwing ideas out there, well, you still have to trade it. Now, if you're a swing trader and you're going to see, that you're going to see your position go against you because of something Trump said, and this is something that we cannot avoid for the next 4 years, right? So if you can grit your teeth and stick through it, and it fits your time horizon, then you ignore it again. Now, if you're a even longer term trader, let's say your time horizon starts at 3 to 4 weeks and it goes to 3 to 4 months, then you can just ignore pretty much everything except the ones that will result in actual action. So I'll give you an example. So rare earths. So the US Department of Defense or the Department of War right now, they were actually serious about investing in rare earths, and this phenomenon predated Trump. The previous administration did it too, just that the grants were kind of small and it didn't make the news. Under Trump, it made the news. Now, same with uranium and same with putting these minerals on a critical minerals watch list. So all these actions, they have an actual consequence, because when you do this, now when you say that you're going to be taking 20 different projects and you're going to fast track their permitting, now that makes a significant impact in terms of, so if you look at the way the mines are valued, if you look at the way they are financed, you know that shaving even a few years off the permitting process adds a lot of value. It's like if you're a real estate developer and you can get your permits tomorrow instead of waiting 2 years for it, the value of the property goes up. So in those cases where the impact is real, yes, it matters. In those cases, like Float's idea of giving $2,000 in tariff dividends, well, that's just fluff. So you don't really have to care about that. And that's pretty much what I do. It's good for a 1 day pump in the market. I'm just going to stick it out and not do anything. But all these things, all these headlines, the one thing that it does, and I know I keep talking about this often, is it erodes confidence in America. The outside world looks at this and they are like, man, this feels weird. So what do? They sell their US dollars and they buy gold. And that's what central banks have been doing all year. And now that's what individual investors are doing all years. Like Bullion Star keeps tweeting about lines outside gold shops. Now, I don't know how much of that is true and how much of that is marketing, because I'm sure there's an element of marketing there as well. But
So I'm not
it's
seeing
true
any
in
of that in the United States currently. Like nothing in the United States currently like that. But I did see it overseas. But that's once again nothing I can see personally.
yeah, and it's there is real genuine demand for gold. We can see it. There's real genuine demand for silver. We can see it. And that's what happens whenever you get these fantastic headlines. People are like, we are starting to think about US risk. So usually people don't consider the US to have any kind of jurisdictional risk. Now, if you go back to pre-Brexit era, it was the same with the UK. People did not consider there was a jurisdictional risk in the UK. And then suddenly it was there and they had to think about it. And it's the same with Germany, with France. I mean, at least with France, you have all these leftist elections and there's jurisdictional risk. But usually with the US, people don't think there is jurisdictional risk, but now they're starting to price it in. So when that happens, your dollar no longer acts as a safe haven. And I think that's what we are seeing at the dollar index. Like, why are we seeing euros going up even though Europe is a mess? Well, it's because it's the anti-dollar trade. No other reason than the fact that Europeans have been pumping capital into the US for more than a decade, since the pigs crisis of 2011, and now they're kind of slowly repatriating a little bit back. And that little bit makes all the difference. So when you have these fantastic pieces of news being floated around, what happens is the US loses a little bit of its luster. The US capital markets lose a little bit of their luster. Other than that, I don't think it's really tradable, because unless you have advanced information about something, it's really not tradable.
No, I think so too. And so let's move past the headlines here. So we got headlines are interesting, something to just pay attention to, but let's move past these for a second. Let's get to some of these questions. So Paris asks, what do you think of Remex for a purchase?
Is that
So is it
the
talking
real
about
estate
buying?
company?
I think that's the rare earths ETF.
Oh, the rare earths ETF. So that's mostly Chinese stocks. So if you're buying in, you're buying Chinese smelters and the like. So I would avoid that. So if the goal is to get exposure to Chinese stocks, Chinese industrial stocks, then yeah, sure, go for it. If the goal is to play the rare earths theme, then I think you can do better. So there's Linas Corp in Australia. I think there's a OTC as well. So you can buy that. You can buy Mountain Pass, MP, although that's kind of like very overvalued now with all the hype that's going on. And then there's Energy Fuels, which is a pure play on rare earths in the US. And then there's Neo Performance Materials, where they're building a processing facility in Estonia. So you can check that out. So I guess if you're looking for a long-term exposure to rare earths, you're better off picking these individual stocks than going with the ETF. But if you're just playing the theme, playing the liquidity, then unfortunately the ETF is the only way to go. But I would really say dig into the individual names and avoid going into the ETF, because you're getting a lot of exposure to China and you may not even realize that you're getting that exposure.
I'm personally very happy with the exposure to China in there. that's what I'm doing it for. But for me, it just depends on what investor you are. You know, Kashop is very good at picking the stocks. He has a skill with that most people don't in the world. And so, like, you know, for me, I really like playing the themes, like understanding, hey, I'm going to be here, but also, like Kashop mentioned, like understand what ETF you're purchasing. Are you purchasing an ETF that's going to be primarily in China? Are you purchasing an ETF that's going to be primarily in a different area? Or are you purchasing a country ETF that you're like 30% is invested into one stock? So understanding those things is very important. So getting to the next one, I keep double skipping. I don't know why. So I was looking at some things, and this is things that we were talking about earlier. I'll run through these real fast, which is looking at a couple catalysts, you know, like what could happen to the market. At the moment, I mentioned, you know, if we're looking at the large cap sectors, we're starting to see them falling below some of their major moving average. So we're starting to see some weakness out there in the short term. Long term, we still are holding up decently. That's when we start to see us start breaking 200-day moving averages in all these sectors. That's when I'd start to get worried. But we're also seeing like defensive sectors like healthcare is starting to show some major relative strength. So I think it's something to continue to pay attention to, look out for here. And then the next one, these are sensitive. So basically, any of the sectors that I want to be paying attention to see when the market's really going to crash. At the moment, this looks very similar. So, you know, not even saying crash. I'm saying crash as in drawdown, bear market, and so on. But we're seeing, you know, only two are above the 20-day MA. Only two sectors are above the 50-day MA at the moment. And 10 sectors are above the 200-day. So if that starts to change, I'm going to say we're starting to really lose that primary trend. At the moment, we're just losing the short-term trend, which happens in uptrends. This happens all the time. So I'm not willing to say, hey, we're heading into a bear market, but I am saying some of these areas look very bad and look like they're getting hit. Bitcoin isn't looking pretty. Speculative growth, it came down a bit, but it's holding up decently, but still an area I really am not in personally myself. Home builders, I don't want to be at home builders. Everybody keeps talking about home builders because they look cheap. I haven't been a fan of them for a long time. Not something I want to touch. The banks don't look really good. So at the moment, it's like there's some reasons to start saying like, hey, this is a time to start paying attention here. But for me, looking at biotech's holding up gives me some hope that the bull market still might hold up for now. Also, industrials are looking pretty decent. Small caps, they're starting to really roll over. They looked really good for a long time, but let's see if they can catch a bid. But really right here, right now, the point of me bringing all this up is like a lot of things need to start to catch a bid for me to get very bullish on this market once again. Like it's all at a breaking point here. So either we start to break down a little bit lower and then we start breaking these primary trends, and then this market's probably going to come down pretty quickly, or we just start to stall out right here. We start to bottom. We start to move higher, and we start to get back to that seasonality that we are used to in November, December. But as you guys remember, we talked about this seasonality before a couple weeks ago. And the thing Kashop and I talked about a ton, which was the fact that if you're, for me at least, this is the way I look at seasonality. I don't look at seasonality like I'm going to buy and sell things on seasonality ever. I look at it in a way that goes, okay, seasonality is good here in November, December. If the market doesn't pay attention to that and the market moves lower, that's a really bad sign. And same thing with summer. Like it was a good sign that the market was going down at the end of spring. And then in summer, when it's usually a weak period in the market was strong. So there's a bunch of reasons to think here that there's a possibility of this thing going lower here. But for me, I'm not just selling out of all my positions and running for the hills. I'm waiting for these trends to break. And at the moment, some of these are hanging on, but some are breaking down. And looking at the leaderboard, you know, total stock market leadership, these are scans we put up in Against All Odds research every single week. Looking at silver, gold, other industrial metals, solar, copper, uranium, like we're still looking at this market in a sense where it's a definitely a commodity driven market. Coal is even in there, renewables, aluminum. So basic oil and gas equipment services is even in there now. So looking at all of these sectors and subsectors, like we're seeing a lot of strength in these areas still. So for me, I want to stay long these areas that are strong. Even biotechs are strong. Like that's fine. If you're a biotech investor, like go ahead. I have no idea how you really trade those. I'm good with trading the ETF, but trading the individual stocks is a mystery to me. The only people I've ever known who are good at it are people who would call me when I was working at the fund and be like, "Hey, this guy's about to do blank," and that's the only people I ever knew who were any good at
So,
trading biotech.
so I have a degree in biotechnology, and I still don't understand these stocks.
That makes sense. It's just like you're basically like, okay, there's no earnings, there's no nothing, but this person has a really cool idea, so therefore I'm going to invest in it. But one thing why I said it earlier, and this is something that's important for macro traders, why I said earlier is looking at biotechnology and seeing it holding up so strong is one of my bullish points that I think I will continue to stick on here. And the reason is that it is a sector full of nothing. Like there's no real fundamentals, there's no real anything besides speculation. And if it's getting bid, I'm not that bearish on the full market at the moment because there's some reason it's getting bid. It's kind of like Bitcoin, but these both are diverging at the moment. So for me, it's a watch biotechnology. If that starts to roll over, that's a really bad sign. Bitcoin is already rolling over. If it doesn't bottom right here, right now, it's also a bad sign. But yeah, it's definitely an interesting market structure at the moment. And one last chart, speaking about Bitcoin, we're seeing this rollover here in Bitcoin, and the S&P 500 has a tendency of following Bitcoin. People, talk about the correlation sometimes, and then like when it feels okay to them to just bypass that whole correlation, they just don't talk about it anymore. And it's like that correlation exists and it's here. And when we're looking at this and you see Bitcoin bottoming out, like that's a time where the market's usually in a pretty bullish posture. And then when you see Bitcoin topping out, it's a period of time where the market could go lower pretty quickly. So I don't know if Bitcoin's going to just do what it does and possibly bottom out here and roll back up. I don't know if it's just going to chop around forever, and I don't know if it's going to head into a bear market. But what I do know is that you have to pay attention to the chart right now. If Bitcoin starts to break down, I would be very bearish on this market. If it just continues to break down, let's say we get past 90, 80,000, like I don't think the S&P 500 is going to continue higher in that. I think it tells us a lot about, the structure of the market. Paris, we're getting to it. I talked to the one thing, we got on a tangent. You guys should know me by now that I don't have like much of a filter and I could end up all over the place on one thing. So Paris had a question for you, Kashab, which is, and we'll end on this. He said, Jason, he already knows my take on this, which is probably like stay long the trend or something. But he said, let's say a gold miner, and this is a question for you, Kashab. Let's say a gold miner is overvalued right now, but I know that gold will go higher, and thus the stock's earning ... In this case, is it better to hold on, book some profit, or completely exit the stock? I just want to know Kashab's perspective on this situation. So he's basically asking if you think gold prices are moving higher and you have a stock that's very overvalued, would you keep holding on to this stock? Would you take profits? Would you sell it? What would you do?
So I think he's talking about the royalty companies because um, at current prices, unless you really look somewhere in the mid caps for an overvalued stock, I don't see too much overvaluation overall in the gold producing space. The miners which actually dig up the earth and convert it into gold. Now, if you look at the royalty companies, that's a whole different story, and they are all fantastically overvalued. Now, here's the thing. So go back to there's a stock in the S&P 500 called Texas Pacific Land (TPL). So you go look at what it was doing in 2004, 2006. And so basically they have a lot of land in the Permian and they get royalties from the producing oil wells in that region. 2007, people said Permian is dead. The Permian Basin is dead, and these stocks went nowhere. And then the shale boom started. Permian became hot. This company's earnings picked up, and it was overvalued all along the way until, say, 2 years back, when they had a shareholder lawsuit and the whole mess. But point is, it spent an entire decade being overvalued and growing into that valuation because it was a royalty company, and the land in which they had their royalties were so prolific, so productive. So in a situation like that, is overvaluation, or it's overvalued compared to even 2 years worth of next 2 years of earnings, is that really a reason to exit a stock? Not really. But if you're talking about a producer, let's say you're talking about a company which is trading at 10 times earnings and their mine life is only to 2 years or 3 years, then in that case, if it's overvalued, you get the hell out, because there's no way that company can live up to the valuation. There's no way they can grow to the valuation, and that's a poor bet. So it really depends. So when you're talking about assets which have a very long life, just looking at earnings, just looking at book value doesn't get you anywhere. You have to look at the growth potential. So you have to treat it the same way you would treat a growth stock. So the reason a Texas Pacific Land or a Franco Nevada can do so well is because these are growth stocks. These are not commodity stocks. So these are growth stocks in the commodity space. And once you make the distinction, you can sort of evaluate these opportunities a little better in terms of valuation.
No, good point. So, all right, guys, we're going to end on that. We'll see you guys next week on Friday. We're here every week at 10 a.m. Please feel free to bring questions. If we didn't get to your questions, just drop them in our comments or somewhere on our X channels or whatever. You know, we'll definitely get to you guys when we can. All right, guys, take it easy.
Bye, everyone.